skies. Thank you, Silvana.
Yeah.
Bank of America topping Wall Street estimates on net interest income and trading revenue in particular. The stock is rising about 3.25% now this morning. Brian Moynihan, Bank of America Chair and CEO, joins us first on CNBC. Welcome, Brian. It's great to have you.
It's good to be here, Sarah. How are you doing?
I'm doing okay, trying to figure out what to read into all of this. I mean, you put up a good quarter, especially on, the trading like other banks and net interest income. How much should we read into this healthy snapshot given the enormous uncertainty we face about what comes next?
Well, I think, Sarah, as we laid out in our earnings presentation, the analysts just a short time ago, we basically laid out our first quarter 2025 results, which was 18% EPS growth, revenue growth, modest expense growth, good credit quality, delinquencies down, charge-offs down, et cetera, and loan growth and deposit growth, showing that the economy is still growing and our consumers are still spending. But on the other hand, we said, here's how we're positioned if any of these things that we all are talking about and you're talking about every day could come true. Differences in policies across multiple dimensions, what that could do to affect business spending and capital formation. And all those things are out there. But in the current environment, we try to draw a bright line saying, hey, the first quarter of 25 was another good quarter for Bank of America.
How much has the trade war impacted the results so far? And if not, when do you expect it to do so?
Well, I think the tariffs and trade haven't impacted our results in the near term because, remember, it was April 2nd, so there were modest tariffs before then. I think what you're seeing is our economists at Bank of America Securities, as well as economists around the street, are lowering their growth expectations and increasing their expectation that there could be a recession up in, from 20% to 40% or whatever the numbers are. And are increasing unemployment levels up a bit. And as you look at all that, how a bank thinks about that goes through our reserving methodology for our loan book. And what we told people is if you take our reserves and our imprecision reserves, our judgmental reserves, and all the conservatives we throw in, we're sort of reserved at a 6% implied unemployment rate, which is far where we are now and above where most people think it will get. So the banks have done a lot, and our bank has done a lot to position ourselves with capital, liquidity, credit quality, multifarious portfolios and for times of stress, of which we haven't really seen other than the pandemic for a long time, and we're prepared for that. And yet you're not seeing reflected in the current numbers. You're reflected more in how we're thinking about credit and provisions going forward.
What do you hear, Brian, from the CEOs you talk to, so many, small, medium, large, about investment and hiring plans given the new tariffs?
Well, I think it's not the tariffs are one aspect of it. You have the immigration policy and the ability to get workers. You have the tariffs. You have the tax bill, which is moving through Congress. There'll be a lot of discussion as it moves towards a final resolution between the two plans and ultimately what they'll get through. And then you've got the deregulation impact across all industries. And I think each of those are hard to figure out, and all of them together, all moving at once, are even harder to figure out. So the new administration came in with ready to go compared to the first Trump administration. They put a lot of stuff on the table. They're pursuing all that. And while we talk a lot about tariffs, all these other aspects are going on too. And the average business owner is trying to figure it out. And that's causing them probably to be a little slower in making decisions on hiring or capital investment until they figure out the path forward. Now, in a company like ours, we've got tens and hundreds of people who spend all their time thinking about that. We've got a research team, which is a great team, that spends all their time thinking about that. But if I saw a lot of mid-sized companies and smaller companies last week. If I were one of them, I'm sitting there saying this is hard to figure out. So they're being a little more conservative. You're just not seeing it reflect in the current asset quality or anything else at this point.
Well, have you seen any notable increases in companies tapping credit lines for precautionary reasons?
We have not. So if you go back before the pandemic, the average draw rate of middle market credit lines was, say, 40% to make it simple. That fell to 35%. It's run around 36%. So you're not seeing people like they did during the first stage of the pandemic 5 years ago. About this time, we saw $70 billion in commercial lending come through in a quarter, which is way outsized compared to what we see. We grew loans 4% year over year. Think of that as $40 billion over a whole year, not $70 billion in a month. And so we haven't seen anything like that. They're calm. They're making money, but they are worried about how all this works and how it can reflect, the changes in supply chain, the changes in cost. Can they pass that through to the customers? But the other thing we have to remember is the U.S. economy is dominated by services too, and those are a little bit different. And one of the worries I have about tariff policy and stuff is when do the services get dragged into it on an international scale? But in the U.S., a lot of services side consumption's been strong. And the last thing I'd say is we told people, and we've talked about it many times, Sarah, is our consumers in the first quarter of 25 moved 4% plus more money out of their accounts than they did in the first quarter of 24. And for the first part of April, using a 4-week average just to make sure we don't have bumps, and it's running about 5%. So the consumers are still spending money despite the polls that say they're going to stop. They have not stopped yet.
I was going to ask about that. And you see that on the high end, low end. I guess the question is how much wiggle room there is.
Well, if you think about their credit quality is strong, they still have money in their accounts, they're employed, and the wage growth has been strong. So that all sets up unless we have more layoffs and more job loss. So what I watch, as I've learned over the years from our team, is I watch the new claims for unemployment, and they're still sitting in the 200 to 230,000 range a week. And that then cycles through in a continuing claims at 1.8, 1.9, whatever they are, a little bit elevated. And we got to watch that. But right now, you're not seeing that impact. When that happens, the consumer will slow down their spending. And we're seeing it across the board. It has shifted in terms of more experiences, services, less travel on planes, but more travel on boats. And it moves around as it always does. But in the end of the day, it's solid spending at a rate that's consistent with an economy that's grown 2%. It's consistent where it was in 17, 18, 19. It hasn't slowed yet, and I use the word yet because it may if there are more actual job eliminations and reductions and people are unemployed. The unemployment rate's still very strong.
No, I know, and it sounds like everyone expects that, but no one knows how much. You said you'd be worried about the trade war if we get into an area where services are included and not just goods. What do you mean by that? What's the worry here?
Well, we export a lot of services in our country along many dimensions, and you're hearing that more on the European side, who import a lot of our services. It's more of a balanced picture. And will they start introducing taxes on various enterprises to start as a retaliation? And that you worry about because that could have another impact on America's competitiveness. And so I think people are talking about that. It's not talked about as much because all the tariffs really are on goods today. And it's about bringing the manufacturing jobs back and about U.S. consumption of U.S. goods produced. But U.S. consumption of U.S. service produced is a big part of the economy, and worldwide consumptions of U.S. services produced is a big part of the world economy. And we want to make sure, we as a country should be highly interested in making sure that stays the case.
Well, despite all of this, Brian, the economic uncertainty about what lies ahead, you did, I mentioned the big beat on net interest income, but also maintaining guidance for fourth quarter on this number. And I'm just curious about why. What gives you the sort of confidence and visibility to do that with the rate outlook also changing?
Yeah, so from the last time we gave earnings to this time 3 months ago, we were at one cut. Now we're at 4 cuts. Now, one of those cuts is in December. That's not going to affect the fourth quarter much. So, but if you look across those cuts and think about them, we've absorbed that in better growth. Frankly, deposits perform better than we thought. In basically, as our portfolio repositions, that happens, and it may, that's going from 2% levels to 4% levels. That's going to be lucrative. It may be if there's 25 basis points of 50, it would be a little bit more lucrative, but it's very lucrative. And so we gave the walk in our earnings presentation, but roughly $1 billion lift from this quarter, completed the first quarter in 3 quarters, is strong growth, and 6 to 7% NII growth is sort of counter the trend, is how our great company just generates more loans, more deposits, and the repricing of the balance sheet, which extracts the value of those deposits over time, produces that NII growth. So it shouldn't change a lot, but it was less than we thought it would be, but we made up for it with other growth and other things going on.
Yeah, what is that outlook for loan growth at this point? I think you put up some of the best of the group so far.
We have low single-digit loan growth, and that's part just return on the investments we've made across the last 3 or 4 years, and more loan officers in our middle market and small business area, business banking, we call it, companies up to 25 million in revenue. Those areas have been growing solidly, except for commercial real estate, which has been flat to down. All those areas are growing solidly, and we expect that to continue because we're actually adding new clients. And so these are highly selected credit-worthy clients, but we're adding them because we've added more officers, the quality of our products and services. Frankly, our international understanding, bringing it to middle market clients, our investment banking capabilities brought to middle market clients, all those add to our client reach in 100 markets we serve in America. And likewise, outside the United States, we've increased our client coverage by a good chunk, and meaning not just the multinationals, companies down to $1 billion in revenue, and that's given us a little more area to play in, and that's resulted in some growth. So we feel very good about the loan growth. If the economy goes into a deep recession, that'd be different. But right now, most people who are even predicting recession are predicting a relatively mild recession towards the end of this year. And our team continues to lower their growth, and we're going from, the economy is growing from a 3% growth rate in the third quarter last year to people maybe somewhere between 0 and 1 as we move into the middle part to the end of this year. That's quite a slowdown, but it's still positive, and there ought to be growth for us to get in that regard.
What about investment banking? How has the outlook there changed? There was so much optimism going into the year about deals and IPOs, and that's been sluggish so far. And now with the tariffs, there are questions about what we'll see.
Well, I think at the end of the day, that area, all the areas you mentioned, whether it's tariffs, whether it's the deregulation policy, whether it's the support for manufacturing build-out and things like that, all of which are coming through. And frankly, getting the tax bill extended is important because that sets the U.S. tax rate, which circa 17, 18, 19 was a reason why a lot of companies were coming here, is a big final demand and a certainty of tax rate and ability to make money and keep more of it. All that going on will help. And so, when you came after the election, there was a lot of enthusiasm and a lot of deals would come through. You saw a lot of deals get announced, and at $1.5 billion investment banking, that's a standard good quarter for us. We would have hoped for more if coming out of the election it slowed down. We've got to get two things. If the market stabilizes, then the IPO market can stabilize, and then the high yield financing, I think a deal got done today. We need the markets to have stability to do that. Right now, there's too much fluctuation. That would then add more activity. The M&As, lots of conversations, lots of pipeline, lots of stuff going on. It's just got to have a little certainty to get those deals signed up and through.
Well, that's the question, is when we'll get certainty and how we'll get certainty. Brian, what do you think we need to see from Washington to get that?
Well, I think we need to get the tax bill done, which is the focus is turning that, and we need right now the tariffs and the negotiation delay for 9 days. We just need it to settle out, and so people can understand how that policy is going to work, and then they need to see the outlines of policies sort of burned in and not talked about, but more, what is the policy? If it's going to be tariffs, then how do I react to it a year, 2 years, 3 years down the road? Those are the things that they need. And I think over the next, if the administration delayed 90 days is negotiating, as this Treasury Secretary and the Commerce Secretary have said on your network, and I've watched them say it, we got to let them do the work. And when they do the work, I think you'll see on the other side of it a reaction to what is as opposed to what could be.
Last week we were all glued to the bond market because Treasury saw their biggest weekly slide since 2001. And some were highlighting the risk of American assets, of the risk premium going up for owning American bonds. And we saw the dollar decline as well. What's your take on that and what we've seen so far in the price action there and any liquidity issues?
Well, I think you saw a lot of movement and a lot of speculation, a lot of debate about whether people were selling U.S. Treasuries. We didn't see a lot of that. What we saw is the liquidation of some of the trades and things that you've written about. We've seen relative condos come back in the market. The gyration of rates has been interesting because at year end to now, there's not a lot of difference. It just went through some pretty good ups and downs. And these are the Treasury markets. They're not supposed to move around like that. So I think, again, it's the same sort of policy clarity it's got to come through that people are trying to figure out that we just spoke about. There's no difference. The bond market's reacting to that and potential impacts on higher inflation for longer because prices go up, or the potential impacts of a constraint in the fiscal situation in the United States due to reducing spending and reducing the economy that way. And so I think longer term, a strong America America leading the world on research and development and intellectual capacity. The capitalism in America ought to win out, and that means a strong dollar and a flight to quality. It's just during times when the policy uncertainty happens, you can see that bounce around. The good news is it's settled back down, and we're watching it closely like everybody else is.
You push back on all the negative narratives. I mean, it sounds like you sound relatively calm, and so I guess you're not worried, about that, the U.S. losing reserve status, the stagflationary narrative, the recession. It sounds like you're feeling okay. You just want to see more clarity. Is that an accurate characterization?
Well, I think I don't want to be obdurate here. I'm saying that I'm talking about what you're actually seeing today in terms of consumer spending, in terms of asset quality in our industry, in terms of capital, liquidity, and how we fight through these times. What we're worried about, like everybody else, is the parade of things that could go on and go wrong. But you'd assume that people who believe it's their job to make the United States effective may have different strategies than prior administrations. The new administrations had different strategies. But at the end of the day, they're going to make sure that the unemployment is in check, that the United States economy is growing, that the United States is still a beacon to the world in terms of economic power and capitalism, our capital markets, which are the strongest. And so all these policies will have to be settled out at some point against those goals, which are the goals that they're stating. So I think the question is, the bumps in the road getting there, but at the end of the day, you got to believe that for a country that's been around for 250 years, it done a lot of great things. There ought to be a pattern that ought to come out the other side that ought to work.
Brian Moynihan, thank you so much for your time on all the hot topics today. We appreciate it, and on earnings especially.
Thank you, sir.
Thank you very much. Brian Moynihan, Chair and CEO of Bank of America. I think another affirmation, guys, of the positive setup, which we've really received from all the big banks, with no major warning signs or flags as far as cracks in the consumer, in credit quality. He even saw, 6% loan growth in the quarter. The setup is okay. The question is what comes next, and nobody can really answer that. I think he raised an important risk about a trade war turning into more of a services war, which is a bigger part of our economy, which we haven't necessarily seen happen yet, but the Europeans have threatened that sort of thing. But also some nice affirmation about the action in treasuries, Carl, and not seeing necessarily cracks in the U.S. exceptionalism story or the liquidity story, just the unwind of a lot of trades, which is something the Treasury Secretary attributed it to as well.
Yeah, 4.35 today is a heck of a lot better than 4.5 plus. That said, trying to regain a little bit of an air pocket this morning. Dow's up 92. Squawk on the streets back after this.